It's a shock alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the U.S. government just did the unthinkable, and what I want you to understand, with 4 months to go to the presidential election, there's nothing that matters more to the Biden administration than the U.S. economy, and in particularly the U.S. labor market. But if things aren't going the way you want, well, there's one simple solution, and that is to pull out all the stops and convince voters that things are far better than they actually are. Plus, we have a sponsor for today's show. We'd like to welcome Canoo Inc. to the show. You can find them on the NASDAQ under the symbol GOEV, and they develop breakthrough electric vehicles and can count the United States Postal Service as one of their customers. And their stock is getting the attention of Wall Street in a big way. It's breaking through supply zones and profile lines and setting up a very rapid 15% move to the upside. This is a chart setup you're not going to want to miss out on. Check them out on the NASDAQ again under the symbol GOEV, or stay tuned to the end of the show, or check out the pinned comment or description for more information. Now, let's head over to Bloomberg. I want to give you some of this setup, and then you'll see what the government just did, because it's by far what I can say completely unthinkable. As the U.S. labor market shows signs of losing steam, putting the Fed on alert. And it's not just the Fed that's a factor here, because voters often factor their wallets and their financial situation when they go to the polls. And if the economy continues to deteriorate, well, they're going to be looking for someone to blame, and in a big way. And companies are posting fewer job openings this year, and employees are quitting less as unemployment has begun creeping up from low levels, signaling the end of the historically tight labor conditions that characterized the rapid recovery from the pandemic shock. But one thing we can note is recently Fed Chair Powell said that he believed that the unemployment rate would not get any higher than 4%. And yet what we're seeing is companies posting fewer job openings, which is an indication of a lack and need of labor. That means demand is coming down, and workers are starting to keep and hold their jobs rather than change, looking for higher payouts. That's because sometimes they realize the last person in a job is the first one out when things go wrong. And strength in hiring has so far helped the economy weather aggressive Fed tightening. In reality, it's not so much that. It had everything to do with how long the pandemic stimulus remained in the economy, and it held on far longer than even some of the most biggest experts believed, and which brought interest rates to the highest levels in 2 decades, as the Fed was hoping to tame inflation using something that doesn't actually work. And with inflation running above the central bank's 2% target, the fear is any further softening in labor conditions could start to snowball and put economic growth at risk. And this is something the Fed has a flawless track record of doing, because there's a simple reason. If you want to look to bring inflation down, well, just put people on the employment line. It works each and every time. And we can see the evidence of that in this chart of the consumer price index against continued unemployment claims. That's shown in red. And back in the 70s, it worked with the lag. Inflation would rally as people lost their jobs, but eventually that lag would catch up as demand plummeted and inflation came down. And you can see that effect over and over. But as we move into more modern times, we do see there are periods where inflation can rally against rising unemployment claims, and then again it comes crumbling down. It wasn't until the dot-com bubble where they started to get more in sync, and it was, of course, almost the same effect starting at the global financial crisis if it wasn't for oil. And you can see the relationship now. Consumer prices peaked at the bottom of continued claims, and perhaps the reason why we haven't seen inflation fall further is that claims have been holding, but as we've noted over the last couple of weeks, they've started to tick higher, and that is a dangerous sign for the U.S. economy, and even worse for the Biden administration, who needs voters to believe that the economy under his administration has been nothing but beneficial to their bottom line. Any changes in the outlook for the labor market could have significant implications for the direction of the economy and monetary policy, and that's absolutely correct. And there's one thing we know for sure is that conditions change very quickly. And in reality, the things for the economy don't change very quickly. It's what happens is the Fed just stays on this too long, and next thing you know, by the time the economy breaks down, it's too little, too late. But one thing you're not too late in is that to get in on the stock for our sponsor today show, Canoe Inc. Again, on the NASDAQ, under symbol GOEV. And look at this chart setup. You can see this beautiful bottom that formed here right at the supply zone where buyers have been at. And each time it gets in it has the potential to jump up here into this roughly $2.50 range. It's breaking through its 30-day volume profile. It's getting attention of some big players, setting up for you to jump in on a 15% move. And that would be a huge boom for your trading account. But let's take a look at how the Fed always gets this wrong because they're late to the game. They sit back and they watch continued claims start to rise, and you'll notice here in blue the federal funds rate, they start to cut a little bit, and then all of a sudden they go into full panic mode. And then by the time the dot-com bubble started, well, they slowed their pace down and let claims rise, and again showed up to the party late as they always do, and then did it again during the global financial crisis. It wasn't until the pre-pandemic era that Powell seemed to have his finger on the pulse and tried to save the economy just before we went, of course, into an all-out global shutdown. This time, he's saying there's no need to bring policy rates down, but if continued claims continue to tick higher, well, what we know is initial claims follow, and then things spiral out of control in a very rapid way. And for the incumbent president, that is not the news he wants to hear, which is why this is something they need people to believe. The economy is good because employers are definitely taking their time and being choosier about who they bring in. And meanwhile, those with jobs have become more wary about leaving stable positions. And that's the key point here. If you're concerned about the labor market, you don't leave your job for new opportunities, particularly if you're looking for a raise. They don't want to be unemployed in this market because they know it's taking longer and longer to find a job. And that's one of the challenges. The economy and the labor market isn't as tight and strong as the political elites keep telling us. And the question some economists are asking now is whether the market is more vulnerable to a shutdown, and it is and absolutely is. In fact, the Goldman Sachs chief economist says we're at an inflection point, which I agree with, where further material softening in demand, which we're seeing every day for workers, will register in higher unemployment and not just fewer openings that are going to come crumbling down in a big way. But the question you're now wondering is what possible move could the government make to make people believe that the labor market is in fact better than it actually is? Well, now we see that U.S. job release unexpectedly, there's a key word, increase from a 3-year low, and all of a sudden this is something nobody saw coming. As available positions increased to 8.14 million from a downward revised 7.92 million reading in the prior month, that was the lowest in 3 years, as according to the Bureau of Labor Statistics, which is why we're outside their office today trying to get answers to what's going on with the job openings and labor turnover survey, or what's known as the JOLT survey. Both hiring and layoffs picked up in a sign of churn in the job market. The quits rate was unchanged, and this report is starting to suggest that workers are getting more confident and they're changing jobs and there's more opportunities out there. But in fact, there's not that many at all. In fact, who's created those jobs may not even be hiring at all. And although the JOLTS data suggests a healthy labor demand, and I'll argue that when we look at the chart, it's difficult to draw conclusions from 1 month. Well, that's spoken like a true central banker. Other figures point to a job market that's slowly cooling and looking more like the one before the pandemic, which we noted and is true based on what we're seeing in a lot of the survey data. We're seeing hours worked get cut. We're seeing employees get cut. We're seeing backlogs get cut. We're seeing new orders come down. Everything we're seeing tells us that we are indeed at an inflection point. Hiring wage gains have eased in recent months, while more people are now receiving unemployment benefits after staying historically low. And here's what we can see. There's a very strong relationship between the JOLT survey shown in blue and continued unemployment claims in red. It's a near mirror of each other, except for right now, suggesting that either the JOLT survey is going the wrong direction and needs to turn up, or perhaps continued unemployment claims are about to take off in a significant way. The May advance in openings was driven by manufacturing, if you can believe that, because this is one of the problems. The survey data said that's not happening at all. So are the Fed surveys wrong? Is S&P Global wrong? Is the ISM wrong? Well, they're all suggesting that employment is not that robust in the manufacturing sector. But look at this, the government sector and healthcare, the key one there being government. Vacancies in accommodation and food services led all industries that decline, which is odd because here we are in the summer months when you'd think that, of course, the holiday season would draw, or the vacation season, that is, would demand labor for accommodation and other services like that. But we'll turn over to Zero Hedge here, who notes deep inside the JOLT survey there was something unexpected. Of the 221,000 total increase in job openings, get this, virtually all, but about 179,000 were government jobs, and maybe they were real, maybe they're not, but we'll let you decide. Weigh in the comments, do you think this is just the Bureau of Labor Statistics trying to make the economy look as good as it can for the Biden administration, or do you think these are real jobs and the economy is indeed turning around into the mythical soft landing that everybody has claimed? Again, weigh your opinion in the comments. Love to know, because if the job openings and labor turnover survey is going right, when you can see as investors are making one of the biggest mistakes in history, because there's a beautiful relationship going back to the early 2000s between the JOLT survey in blue and the NASDAQ 100 in red. And you can see right now investors are buying stocks at all-time high, driving them higher, buying even more, driving them higher. And meanwhile, the JOLT survey is saying the U.S. economy is going the wrong direction. Historically, that means we're in for a big shock when stocks come crumbling down. But how about the rates market? Well, investors believe rates are way too low and need to be significantly higher. And of course, the Fed believes the rates need to stay elevated as well. And you can see further policy mistakes as investors taking too much risk in the equity market and not looking at the bond market here. And what this is telling us is that interest rates are actually going to be a problem. They're too high. They're not leading to economic growth. And when that happens, rates need to come down. But investors continue to say no, dumping bonds at every opportunity. Here you can see the yield on 2-year Treasury securities against the JOLT survey. That's still shown in blue. And whenever you see weakness in the labor market, again, it means rates are too high. But this time the market says, no, they're not high enough. We need them to keep going up. And that is going to do serious damage to, of course, the labor market. And that's when we talk about how fast things can get out of control. And when they do, there's no stopping this economy from melting down into a recession. And given the health of our small and mid-sized regional banks, we're set up for an all-out financial crisis. And Powell weighed in today as he says he welcomes the recent data, but needs, well, more confidence to cut. But he may be one of the only people left with this view. He goes on to say today, because the U.S. economy is strong and the labor market is strong, of course, I'm Powell, I'm going to challenge you to ask the question is, for how much longer? My guess is maybe you've got a month and a half, not much, because if continued claims tick higher, you're going to be cutting in a big way. And he thinks we have the ability to take our time and get this right. I completely disagree. He says that's what we're planning to do, which will send the U.S. economy into recession each and every time. And this is why we saw Treasury yields decline after Powell's remarks. And yet what happened immediately after is investors stepped in and slammed rates right back higher. Again, investors buying long the equity market, short the bond market. that they just don't understand what the JOLT survey is really telling us is the path and the trend of the labor market is indeed going down. It's continued claims, which we'll get more data on that this week. If that's continuing to head higher, it's game over. In fact, it may be game over for Fed Chair Powell because he's starting to lose confidence in his own team. As Goolsbee says, the policymakers should prepare for rate cuts as he believes we're already on a path to get us to 2% inflation. And if you just hold rates where they are while inflation comes down, you are tightening. Well, technically that is correct, Goolsbee, who is the Fed chief out of Chicago. So you should do that by decision, not by default, making a comment to Powell. Of course, what we note is what the Fed chief wants, the Fed chief gets. What Goolsbee is starting to say is there's dissension among the Federal Open Market Committee. We got to this rate when inflation was over 4%, and inflation is now down to about 2.5%. So if you sit with a rate somewhere while inflation goes down, you're tightening. And the reason you would want to tighten is if you think you're not on the path for 2%, which we know we are. But inflation appeared to be returning to target when we hit a bump in road in January, but now we've got a string of improved inflation readings, which indeed is validating that everything is headed the right direction. But even Goolsbee is starting to see things go wrong in his own area because he notes if employment starts falling apart, perhaps sending a warning to Powell, or if the economy begins to weaken, which you've seen some warning signs of, you've got to balance it off with how the progress you're making on the price front. If the employment rate is still quite low, but it has been rising, and that's what makes us question, of course, today's JOLT survey and what the real reason is behind it. But something that's rising we think is going to head higher by about 15% that you can take advantage of, and that's the stock for our sponsor today's show, Canoo Inc. You can find them on the NASDAQ under symbol GOEV. Let's take a look as all the information is in the pinned comment and description below. And GOEV, their approach is a highly profitable, large market. They're looking to build their line around economically resilient customer base and product validation with customers, making sure they're building the products their customers want. And their focus is on commercial fleets, government, and military, which we know usually have large budgets and tend to buy over long periods of time. In fact, one of Canoo's customers is now the U.S. Postal Service with their LDV 190 right-hand drive here. You can see that, and I'm going to guess we're going to see a lot more of these. Right now, you can find them in Atlanta, and it may be in time before we see them all over the country. And here you can see they're proud to announce their LDV 190 vehicles have been delivered to the United States Postal Service South Atlanta Sorting and Delivering Center are already delivering mail. These vehicles speak to the differentiation of our model where we deliver unique, customized configurations to meet the needs of our large fleet customers and their associates. And Canoo received discounted manufacturing assets to their Oklahoma facilities as they look to be very smart with their money. As a high-tech advanced mobility company, they announced the first two tranches of new or like new advanced manufacturing assets formerly owned by Rival Automotive UK Limited at its foreign trade zone designated facility in Oklahoma City, Oklahoma. And Canoo has a domestic-focused supply chain with over 90% of its parts sourced from the U.S. or allied nation and utilizes a skilled American workforce. The completed general assembly line will include innovative robots, paint systems, and an uplifting center powered all by clean energy. And Canoo will continue to pursue opportunistic purchases of advanced manufacturing equipment as it becomes available using its disciplined approach. And they've also joined the Russell 3000, Russell 2000, and Russell Microcap indices that effective on July 1st. And this is bringing a lot of attention to their stock. Let's go back and look at that 30-day chart because what you can see here, it put in a nice bottom. Buyers came in and defended the price. And what we note, it rallied right back into a prior supply zone right around $2 a share. And this is a zone where we've seen buyers at before, and every time it gets in here, you can see price tends to rally right out of that zone. It came back in here, it pushed up, sellers were there, and now it's breaking through the volume profile. We note that sellers have been sitting right here. A break out of that, you can see how quickly it jumps through the next supply zone right around $2.20 a share, all the way on a path to potentially $2.50 $1.50, or what is a 15% return. Again, you can find them on the NASDAQ under the symbol GO EV. As we zoom into the 10-day window, you can see buyers stepping in here. There's your volume profile. All these buyers beneath here driving price higher. Every pullback, they're stepping in, looking to take Canoo stock to new heights, and you too can join in on the revolution that Canoo is looking to have in the EV industry with their breakthrough vehicles. Again, on the NASDAQ, under the symbol GO EV. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.